Hey everyone, it's Mike from Order Flows, and welcome to the Order Flow Delta Trading Course Lesson Number 1, Delta Explained. By the end of this lesson, hopefully you should understand Delta and how to start using it in your trading. But before I begin, a brief disclaimer. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that could be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. So the age-old question, what causes the markets to move? When you come to trading, that's the question you got to ask, because that's how you're going to make money in the markets, is by catching the movements in price. And it's the constant activity of buying and selling by the different participants in the market. You have people that have completely different reasons for buying and completely different reasons for selling. And in the old days, when you would call your broker, you'd say, hey, what happened to the market? Why did the market go up? He'd say, well, there's more buyers than sellers. That's not an answer. That's what you would call nowadays fake news. There's never more buyers than sellers, nor are there more sellers than buyers. What you have is different market participants showing their aggressiveness in the market, and that's what causes the markets to move, is either the aggressive buying or the aggressive selling. And what Delta does is it highlights to you who's in charge, the aggressive buyers or the aggressive sellers. Now, in order flow, there's a piece of information that's very valuable to a trader, and that's order flow delta. Don't confuse this with options delta. Okay, order flow delta is a measure of aggressive buying or aggressive selling going on in a bar. And delta tells a story of what's going on in a specific bar, and when you start putting the bars together, you get a feel for what the market is doing in general. And when you start to understand delta, you can use it in your trading, and sometimes it's very, very clear on what you're seeing in the markets. Unfortunately, it's not always this clear. There's a lot of activity going on, and the market exists to facilitate trade, to transfer risk from one party to another. But sometimes you see things in the delta and you just sit back and say, oh God, that was so obvious. How can I miss it? And that's why I'm creating this course, so you can start to know what to look for and know what to see in the delta. And as you can see here, how the delta at the bottom here is getting weaker and then getting stronger. As the market's selling off, it's getting weaker, and as the market starts rallying, it's getting stronger. It went from minus 103, minus 88, minus 58. So negative deltas are getting weaker. It's getting closer to zero, turning positive. It turns 24, 100, 167, 205 as the market starts rallying back up. So you can see as the market is coming down, aggressive selling is getting weaker. Then as you come into the bottom, aggressive buying starts picking up and getting stronger, and the market rallies. And the same thing up here. Aggressive selling getting weaker on the way down, minus 411, minus 287, minus 169, minus 101, and then positive 52, 54, 113 as we start rallying back up here. So you can see we're coming down. Delta's getting weaker, start rallying. Delta's getting stronger. Now again, I wish every chart was as clear as this, but just forewarning, don't expect every chart to be as clear like this. But sometimes the market does exhibit it during the day, and really what the point is of this course is to teach you what to look for in delta, the different signs in the delta that something interesting is happening. Lots of times market is going sideways, you got delta going positive, negative, and it doesn't give you any clue. It's when it starts to give you clues like this that it just really the market's sorting itself out and is going to be a great trading opportunity for you. So to understand what delta is, you have to first understand the different types of buyers and sellers in the markets. You have passive buyers, you have passive sellers, you have aggressive buyers, you have aggressive sellers, and each one has its own purpose. And passive buyers are traders that work bids in the order book. They either work bids on the best bid or bids below the market. Passive sellers are traders that work offers in the order book. They're at the best offer or higher. And basically, passive buyers and passive sellers let the market come to them. It's a bit like fishing. You throw your you throw your bait in the water, your line in the water, and you wait for the fish to come to you. You're not actively going out there trying to catch the fish, in the sense that you're in the water searching around for fish to catch. You just throw it out there, and fish comes. He comes. If he doesn't come, okay, you don't catch anything. Now, aggressive buyers are the opposite. They're the traders who buy at the market or lift the offer. If they're aggressive buyers, their aggressive sellers are the ones who sell at the market or hit the bid. And aggressive buyers and aggressive sellers want to get filled immediately. They want to get into the market immediately. A passive buyer doesn't have that urgency, doesn't have that need to get into the market for whatever reason, that they have to pay the market price or sell at the market price. They're willing to let the aggressive buyer come to them. And again, think of it in general terms, okay? Like everyday life. You want to buy a car, okay? You want to buy the new Chevy Corvette, okay? List price for that is, whatever, $85,000. And you don't want to pay $85,000. You want to pay $75,000. But the dealer, he wants to sell it for $85,000. And there's no trade that's going to happen. You're not going to be able to buy that car because you're at 75. He's at 85. It's when one of you gets aggressive, if you think, oh my gosh, you know what? I need this car. I got to impress, this new girl that I'm dating. I need a nice fancy car. Okay, I'll pay it. What's the selling price? Well, now I'm at 85,000. Okay, done. I pay 85,000 for it. You're the aggressive buyer. Now, if the car dealer knows that you're a bidder there at 75,000, and he's thinking, oh gosh, I've got 5 of these on my lot, and next week I'm getting another shipment of another 20. I'm gonna have 25 on my lot, and they're not selling as fast as I thought they were. I gotta get aggressive. So he goes down. He hits your bid. He sells it to you at 75,000. He was the aggressive seller. Okay, and I said no trade is going to happen until one of the parties is aggressive, either the buyer or the seller, because what you have is going to have someone sitting on the bid, someone sitting on the offer. An aggressive buyer buys from a passive seller. An aggressive seller sells to a passive buyer. And remember, for a trade to take place, someone has to be aggressive. Okay, if the lion wants to eat, he's got to get aggressive. He's got to get up off his butt and go eat that carabao. He has to go and attack, right? And that's the same thing in trading. If a trader wants to get into the market, he's got to be aggressive. He's got to put on a trade. He's got to lift the offer or hit the bid. Now, delta is the difference between the number of aggressive buyers and aggressive sellers in that bar. I should put that there, in the bar. Okay. And that's important because once you start noticing how many aggressive buyers are or aggressive sellers are, one side is going to be oftentimes much stronger than the other side, and that's going to give you a clue into what is going on in the market. And like I said, sometimes it's going to be so clear you can't help but say, wow. Okay, and here's a perfect example. Market's selling off, right? You have negative delta, so aggressive sellers are in charge. But as you start coming into the bottom, okay, you start seeing delta getting weaker, minus 461, minus 255, minus 62. Then right on the bottom, positive 8. Small delta, but a positive, okay? So what's happening? The selling is getting weaker as you're starting to bottom out. And then as you bottom out, you see aggressive buying coming in. What's happening? The market's selling off. It's getting cheaper and cheaper and cheaper. And as it gets cheaper, it starts attracting buyers, right? Because people are saying, hey, you know what? This market's cheap. I should get long. And then you start seeing it, the aggressive buyers are outnumbering the aggressive sellers, right? Because remember, delta is a difference between the number of aggressive buyers and aggressive sellers in a bar. So when you see, minus 461 as negative delta, there was 461 more aggressive sellers than aggressive buyers in that bar. Next bar, minus 255, tells you there was 255 more aggressive sellers than aggressive buyers in that bar. It's still negative, but it's getting weaker when you start putting it in context of what's going on in the market. We went from minus 461 to minus 255. Next bar, minus 62 delta. Okay, so it's telling me still negative. Market's still under pressure. Sellers are still in control. So minus 62 tells me there were 62 more sellers than buyers in that bar. And then boom, you hit the low. What do you get? Positive 8. Okay, small number, but it's telling me there was just over 0 more aggressive buyers than sellers. So it's positive 8. There's 8 more aggressive buyers than aggressive sellers. Next bar, positive 93. It tells me now you have 93 more aggressive buyers than sellers. Next bar, positive 140. So it's telling me you had 140 more aggressive buyers than sellers in that bar. So what's happening as we're forming this bottom? The aggressive selling is getting weaker and aggressive buying is getting stronger, taking over. And what happens is the market rallies. Again, sometimes it's going to be very clear like this, that you're going to say, God, delta is the greatest thing ever. But there's going to be lots of times, like you can see in these other bars, where delta is just kind of mixed. Minus 80 plus 26 plus 266 minus 7 plus 80 plus 83 plus 191. But there's times, when it's just super crystal clear like that, and you got to know what to look for in the delta for it to be useful to you. And think of it like a plane coming in for a landing and then taking off again. Markets don't just drop immediately; they come in softly, like an airplane coming in for a landing, then they start to take off. Right? They decelerate. I'll say slow down, but they're coming in, come in for the landing, touchdown, then they start taking off. They start pushing the thrusters or whatever the planes do to go forward, to go back up again, and then you see how the delta is getting stronger on the way back up. So delta is important because there are times when one side, either aggressive buyers or aggressive sellers, are really showing their hand in the market, and knowing when it's happening gives you an edge over other traders who don't know what's going on. And why don't they know what's going on? Is because they don't understand delta. And to see the delta, you don't need, level 2, level 3 data. You can just use the regular data feed that comes from the exchange, from the CME, from NYMEX, from Board of Trade. That's the same data feed that you use in an order flow chart. Now, again, it doesn't matter if you use my order flow chart or you use many of the other order flow charts. As long as you can see delta, that's what matters. You should have a footprint chart that prints delta so that you can use it in your trading. And again, it's just an extra tool. Imagine it's like having Jack and the Beanstalk beans, but it's information out there that very few other people are using, period. And partly because they don't have the proper charting software that shows it to them, shows that information to them, and two, they think, oh, I don't need it. I'm successful using RSI and MACD, when they're really not. Here it's a lot clearer. You can see, buying pressure is getting weak, or selling pressure is getting weaker. Buying pressure is getting stronger. It doesn't get any more clearer than the delta numbers. And generally, a market is going to rise on positive delta. As you can see here, the market's rising. You got positive delta: 522, 3156, 2807, 3808. 4342, 3543. Then you hit your high. Markets will generally sell off on negative delta: minus 29. Okay, you got one bar with positive delta. Then minus 1676, minus 4377, minus 3502, minus 2305 as you start selling off. And like I said, oftentimes this is how delta looks. There's no discernible reading that you can put your hand on. It's minus 3000, plus 500, plus 3000, plus 2800. But there are times, as I've just shown you on a couple of charts, where it's very clear. And later on in the lessons, I'm going to show you 7 different trading setups that you can look for in the delta and use it in your trading. Now, I say generally, okay? Generally, markets go up on positive delta and markets sell off on negative delta. And the reason I say generally is because it doesn't always happen that way. And when it doesn't, there's often a reason, and the reason is important and potentially a great trading opportunity. I'm going to explain that later in the lessons, actually. But there are times where a market can be rising on slightly negative delta and selling off on slightly positive delta. And that's important because, it's oftentimes, traders tend to think that, well, a market has to do this, and if it doesn't do that, then the market's wrong. No. Don't fall into that thing of saying, well, the market has to, we got positive delta, the market has to be rallying. If you have positive delta and the market's not rallying, then that means something. And what I'll be explaining that later on, what that means and why that happens. So why is delta so important? Why do I keep talking about delta? Is because it's going to reveal areas of supportive buying or resistance selling in the market. It's going to help you see shifts in supply and demand, and it's going to also show you areas of accumulation and distribution. And these are all important parts of trading. This is how traders make their money. They see the areas of support and resistance selling. They see the shifts in supply and demand. They see accumulation and distribution. And delta is a great tool for seeing that information in real time, so you can be seeing it. Like if you're looking at a chart and you got some, moving average or some other indicator on here, by the time this market's already turned around, you saw that it picks up a shift in supply and demand. market's already moved. But if you're watching the delta, if you're tracking the delta, you can see how it's getting weaker. Okay, and then demand is picking up. So you can see it a lot earlier than if you're using some price-based indicator that lags the market, because price-based indicators generally lag the market. I'm not going to get into that in this course, but they do. Okay, price, I don't want to say price itself is a lagging indicator, because obviously price is what you trade. But if you're seeing what's happening between the internal struggle of buyers and sellers, you can see earlier when things are changing in the market. So delta is going to reveal areas of support and resistance, and it's important to understand delta so you can see those. And when you look at the delta, you're going to see who's in control of the market. A strong positive delta indicates aggressive buyers are in control. Yes, right? That's something you got to understand. Strong negative delta indicates aggressive sellers are in control. So when you're looking at positive delta, okay, just remember buyers are in control. When you see negative delta, sellers are in control. And earlier I talked about aggressive buyers and aggressive sellers, but I want to take a moment and talk about aggressive or covert actions, if you will, by traders. Now, when you think of aggressive actions, right, you think of people lifting the offer, people buying at the market, but there are aggressive actions that traders can take when they're trying to disguise what they're doing in the market. Now, aggressive actions is different than aggressive buyer or aggressive seller. So best example is going to be an iceberg order. Okay, a large trader has a large quantity to execute, but wants to hide what he's doing to the trading public. He wants to be aggressive. He wants to execute his order aggressively without being aggressive in the market, if that's possible. And that's why they use, things like icebergs or even these execution algos. And the best way to describe it is, it's like the bear, right? In the salmon, when they go back to lay their eggs, the bear, he wants to eat. He realizes he doesn't have to be aggressive and go in the water and just, slap the water around until he finds the fish. No, he could just sit there lying in wait and boom, eat the fish. The fish will literally just jump into his mouth. That's the way I like to look at, aggressive covert trader behavior, like an iceberg order. So the aggressive and covert actions by traders offer support and resistance in the market. This is just one way you can see support and resistance in the market. And think about it for a second, okay? Say you're a trader and you got 800 lots of crude oil futures that you have to buy. You're not going to just buy 800 at the market. I mean, you could, but you're going to move the market, right? And your average price is going to be really lousy. So what a trader will do is he's going to iceberg his order and manage it from there. He'll put in to buy 800, but he'll, on the iceberg, but there's a little field on the order entry that's, you could enter your quantity for your iceberg. So, maybe he enters 8 lots. Okay, 8 lots isn't going to really spook the market so much. So he's got 800 to buy, but he's going to show 8 lots at a time. And then he just manages from there. So, he may buy the offer and let it be bid. And then people will come in and start selling into his bid. He's happy. He's the bear. He's the bear here waiting for the sellers to come jump into his mouth. He knows he's got a lot to buy. Nobody else knows that. But it's going to show up in the order flow. That's how a delta can be negative and the market rising, because what's happening is you have aggressive sellers selling into his iceberg bid, and it's registering as a aggressive selling action, even though the buyer is being aggressive in the sense that he's got a lot to buy, but he's hiding. He's doing a behavior that's aggressive. He's not trading in an aggressive fashion in the sense that he's lifting the offer, but he's using a method that's trying to hide his aggressive trading. So it's going to show up in the delta, okay? And it's going to show up as a negative delta because someone sold into his big bid that he's hiding there. And this is why you often wonder why the market rises on the negative delta. He's not an aggressive trader per se. His trading action is covert in the sense that he wants to hide it without moving the market. But what does it mean when you have strong positive delta and the market sells off, right? how can that be? You think, why do I got positive delta and the market's selling off? I have aggressive buyers coming into the market, yet the market is selling off. And more importantly, you want to know, what does that mean to you as a trader? In the previous example, in the iceberg example, that was offering support to the market. This is the opposite. You have strong positive delta and the market is selling off. Why is that? It's because you have an iceberg, but you have a selling iceberg, right? You have someone that has a lot of supply. They want to sell. You got some guy thinking, oh God, I just did a deal in the cash market, and all of a sudden I'm going to have a lot of supply of crude oil. So now I got to sell 800 contracts of crude oil to, offset this position. So what he does is, instead of selling 800 and moving the market down, last thing you want to do is move the market down if you're trying to sell, right? You want to sell at a higher price. So he'll iceberg the order. But aggressive buyers will come in and start buying the offer because they think, oh, this, they don't know that there's a big offer up there. So they're buying the offer. They're buying the offer, and it's showing up in the delta as positive delta, okay? Because you have aggressive buyers keep lifting the offer until they realize, what, there's a lot of supply up here. When they see, all of a sudden 500 lots have traded on the offer, they're buying it and trying to get it to go higher, but it's just stuck there. It's not going higher. It's registered as a positive delta of 500, and then these buyers think, you know what, I'm stupid. I got to stop buying here because they're selling, and then I could buy it cheaper. So then what happens is the market starts, once that buying pressure is removed, once the traders realize that, hey, you know what, there's an iceberg here, I don't necessarily want to be buying it there. And then the market starts moving down, down, down because that buying pressure is gone, and then eventually the market starts trading lower. And that's why you'll have this residual, this sort of leftover delta from earlier in the bar, which was positive. And maybe there's not enough volume before the bar closes to turn it negative. That's how a market can sell off on positive delta. Now you have to think about how a bar is formed, right? There's a beginning, which is the open, the middle, which is basically the trading period, the trading session, and the close. Think of it in a daily bar, right? You have the opening, you have the whole trading session, and you have the close, right? You have the open, the body, so to speak, and then the close. And individual bar has the same thing, whether you're looking at a daily bar or a 1 minute bar, they all have an open, a middle, and a close. Or, open, a high, low, and a close. And an individual bar is going to tell you a story. There may have been a lot of early buying going on. Maybe it was met with some supply. Then the market was trading sideways before the market sold off as the supply overwhelmed the buying. And examples like that happen every day, but it's more importantly, they happen intraday as well. And this is where delta comes in. Once you start taking these individual bars together, it really reveals the story of the market that's happening. And delta is going to allow you to see shifts in supply and demand that may otherwise go unnoticed. Now, under the law of supply and demand, remember, it's the law of supply and demand. It's not a theory of supply and demand. Prices go higher when demand is strong, and when demand is strong and supply is weak. Prices go lower when supply is strong and demand is weak. Now, that's basic economics 101. If you ever studied economics in school, that's what they teach you. And again, remember, it's the law. Follow the law. It's not a theory. My wife, when she drives, sometimes, she doesn't stop at a stop sign. I get angry. I was like, well, why don't you stop at the stop sign? You want to kill us all? Well, there's no other cars. Well, I don't care. It's the law. You have to respect the law. It's the reason it's the law is because you have to stop. Otherwise, you're going to get killed eventually. And it's the same thing with supply and demand. Prices go up when demand is strong and supply is weak. Prices go lower when supply is strong and demand is weak. Now, take that concept and apply it to the markets. What is demand? Demand is buying. People are buying something, they're demanding it. So they're standing there, take my money, basically. I want this item, take my money. Supply is basically selling. There's people that have a lot of supply of something, a lot of Beanie Babies or something like that, and they got a lot of supply, so they got to sell it. They can't buy any more until they sell the Beanie Babies that they have. In basic, prices go higher when buying is stronger than selling. You just swap out the words demand and supply. Prices go lower when the selling is stronger than the demand. So if you're looking at a normal bar chart, how can you tell when buying is stronger on a bar chart? You can't, right? Some people will say, well, I look at candlesticks and I can see, you got the wick here and the wick up here. So, prices being rejected there, prices being rejected there. Well, that's all well and good, but oftentimes, markets trade in ranges. So you're telling me, well, prices up here is being rejected, price down here is being rejected, so we'll just go sideways forever. And it doesn't work that way. You want to know when demand is getting stronger. But if you're looking at the delta on an order flow chart, you're going to be able to understand when the buying is getting stronger, or when the supply is getting stronger, or the selling is getting stronger. So let's take a look back here. This is this area, the sideways area right here on an order flow chart. And you can see as we're going sideways, delta is mixed. In this yellow box down here, minus 48, minus 557, plus 157, minus 975, 9, minus 1400, plus 1000, and then minus 1109, minus 247, plus 2368, plus 2827. Even the next bar is still strong, plus 6280. So what's happened? Delta's mixed. Okay, this is what happens when delta is mixed. You tend to go sideways. It's alternating, positive, negative, positive, negative. Now you start to see a little pattern here. It's starting to get weaker and then stronger. Minus 1000, minus 247. Okay, still market's not moving. It's not going anywhere yet until you start seeing the aggressive buying coming in. Plus 2300, plus 2800 as you start to break out of this area that you're trading sideways. And then it's just off to the races, positive delta all the way up, except for one bar right here. And this is what makes delta so important, that as a trader you should be looking at it in your trading and applying it to whatever form of analysis that you're using. I mean, you don't necessarily have to use order flow by itself and think, order flow, well, this is the answer to my trading. No, you may have, a method already of trading, of looking at the market, but, it's just sort of break even for you, or you're sort of struggling one way back and forth. And I really believe that adding delta can help push you over the hump, to give you that extra insight into the markets that you had been lacking. Here's a perfect example. You hit this high, then you start to come off. Okay. What's the market going to do next? Is the $1 million question. Are we going to go back up, or are we going to start selling off again? This is what you want to know as a trader. But you're up here at your high, and you just see strong negative delta up here. You don't want to be, you don't want to be coming up to a high and then thinking, oh my gosh, are we going to go higher, or are we going to start selling off? If you're at the high and you just see negative delta, chances are you're not going to go much higher. You're going to look for that sell-off. And if you see it, here, this one bar right before the high, is positive, very strong positive delta, 4,331. Then you hit your high, you got negative delta, minus 576. Next bar, minus 1238. This next bar, 1,067. It's positive. Okay, I'm a bit confused is what you're going to say. But then watch the next bar. Okay, start putting them together. Start analyzing what's happening in the market based on the delta. So what's happened? You hit your high. After you hit your high, the next four bars, it's negative delta, except for one. You got a positive delta. Okay, but here, next bar, negative delta, and you start selling off from 2902, 2903. I should have put the other chart on here, but it started selling off below 2900. Okay. Here's another example, right? I mean, oftentimes they'll say, you're putting up the same chart. No, these are not the same charts. These are different charts. This is crude oil this time. This other one was, S&Ps. Earlier, I showed you, different markets, and you can just see it, the same thing happening, as delta's getting weaker. Here, it's sort of going back and forth. It's negative, minus 180, minus 261, minus 83, minus 239, minus 254, minus 92, right on this low. Then positive 104, 193, positive 666. But what you're looking at as you're tailing off, coming into this low, it's getting weaker. Minus 254, minus 92 on the low. And then it starts rallying right off the low. Now here you got that negative delta on an up bar. And what does that mean? It means you had some supportive buying going on down here at the bottom of this bar. You had people working bids. You had support in there. That's what support is. Support is passive orders. Resistance is passive sellers. Support rather is passive buyers. Resistance is passive sellers. So why do you got negative deltas? Because you had some passive buyers down in here, and early in this bar you had very aggressive selling going on. You even see this imbalance of 114 and an imbalance of 38 down here. So you know that there was strong bids down here, that you had minus delta, that eventually the sellers are saying, you know what, there's support down here. They realize there's support down there, and they start bidding it up. There's people that were selling it. I don't want to be short down here if I know there's support down here, because why would I sell into support? You want to be buying off support. And then the market starts rallying back up, and you can see it in here as it's happened, as it's turned. If you're using price action, people say, well, here you got this triple top, so I'm gonna wait till we break out of it up here, at 69.35 to get long. Well, here off the delta, you could be getting long 15 ticks lower. You could be getting long at 69.20, even in this bar over here, or even 69.25. You get in a lot earlier because you understand what's happening in the market. So accumulation and distribution, you hear this a lot nowadays. I see a lot of people talk about accumulation and distribution, and people actually talk a lot about, I think, more in terms of equities than they do necessarily than futures or even Forex. Because Forex, generally you don't talk about accumulation or distribution. Forex is more used as a hedge, but portfolio managers, they build an inventory of stock, and they got to distribute it when it's time to get out. And when you think in terms of inventory, if you run a business, right, there are times when you need to buy inventory. And there's times you have too much inventory. You need to basically start distributing your inventory out. In other words, you got to start selling it. And institutional traders, their position is their inventory, basically. And when you start seeing distribution, you can see it in the delta, because the selling is going to be consistent and is generally going to be getting stronger. And you can see here, okay, market's basically going sideways. You look at the delta, it's in the sideways action, minus 993 plus 1168 plus 1280 minus 2741. Then in the box, plus 673, and then minus delta, minus 778, minus 1265, minus 1829. Distribution now is starting to occur. People that have excess inventory are thinking, you know what, I don't want to be holding this because it doesn't look like we're going anywhere soon. We're not going higher. I got to start dumping it. And they start selling it a little bit more aggressively in each bar. Subsequent bars, they get more aggressive, and you can see how the market sells off. Again, you can see even on the delta, minus 778, minus 1265, minus 1829, minus 2442, minus 2691, minus 2724. That one's very, very obvious, but you could pick it up a lot earlier up in here, as it's starting to happen, as the distribution is taking place. Accumulation, same thing, but in opposite terms. Okay, what's happening? Market's going sideways, and you got mixed delta. Again, you can see these deltas. You got a couple bars with negative delta, then positive, then negative, then positive, then a couple negatives, positive, negative, positive, and then you get a big bar in here with strong negative delta, but the market isn't really going anywhere. We're in a sideways action. But then you start seeing accumulation taking place. Plus 385, plus 545, plus 1013. So aggressive buyers are starting to build their position. They're starting to take a view of saying, hey, you know what, we're going to come out of this consolidation and start to rally. And then what happens? The market rallies. This is what accumulation looks like. Now, delta is going to indicate to you when a market is dominated by aggressive traders. And like I said, positive delta is aggressive buyers. Negative delta is aggressive sellers. And this is going to be important once you start putting it together with where the market is, again, with context of the market. For some reason, traders like to lose track of context. They oftentimes, they take a signal based on, I don't want to say a black box, but based on an indicator, and they don't take it in context of what the market is doing overall. So here you go. Market's rallying. Okay, market's rallying. It's on nice, strong, positive delta. Now you're at your high. It's the high of the day up here. And what happens? You start stringing together negative deltas. You know, from your high, you've got 1, 2, 3, 4, 5 bars. What do you have? Actually, 6 bars. You got negative delta, positive delta, negative delta, negative delta, negative delta. You've got, at your high, you've got aggressive selling taking over. You have 5 bars of negative delta versus 1 bar of positive delta. You know, so you got to start thinking, hey, we're at our high. What am I seeing? I'm seeing selling coming in. I'm seeing aggressive selling. I'm seeing negative deltas. So what are you going to do? You know, if someone's got a gun to your head, take a trade. What are you going to do? You're not going to get long. You're going to get short because you're up at this high and you're seeing overall negative delta, right? You don't see all bars negative delta, but the majority of the bars is negative delta. So what happens? It reasserts itself a little bit later on, and the market sells off nicely. You know, this right here, you know, 145, 242, 121 is just after where that box was, and that's right here, 145. You know, if you were to look at these first 4 bars, it's minus 390 minus 145. So, you know, over the subsequent next hour, we sell off from 6630 all the way down below 6600. And that's something that you can see in the delta. And hopefully by the end of this course, you can start looking for that and putting those pieces together in your trading. So this is the end of lesson 1. In lesson 2, I'm going to discuss how to read delta so you can understand what you're looking at. Okay, so I'll see you on the next lesson. Bye-bye, everyone.